Good afternoon.
Hi, everyone. Can you hear me?
Yeah, we can hear you very well.
That's great. Thank you.
And let me introduce Kolkata Investors Group. Kolkata Investors Group is based out of Kolkata in eastern part of India. And we started during pandemic time, sometime last year in May, June. And we have been inviting people like you and others on every Saturday and sometime on Sunday also. So friends, today we have session with Spier. He is based at Zurich and he is running Aquamarine Fund with a lot of investors. He is author of the Education of Value Investor book, which is almost turned into 9 languages. He is famous for bidding $650,000 $100 with Mohnish Pabrai for charity lunch with Warren Buffett. And that happened on 25th of June 2008. He is an ardent follower of Warren Buffett style of investments. He studied law at Oxford and management from Harvard Business School. We are very happy that you are with us. And as discussed through emails, maybe you can initially give your framework to identify businesses for long-term compounding, including how to think about evolving moats. You can modify this to the extent you require. And once you get over, then we will have some question answer and we'll close in 90 minutes. Over to you.
So thank you, BL, and welcome all and hello all. Just to double check, you can all hear me, is that correct?
Yeah, we can.
I don't need to make any adjustments. That's good. I thought that I would have a proper microphone, but I'm just using the computer mic, which is a shame, but that's okay. So I don't know if we'll have 90 minutes time to fill, but I'm just going to go through about 5 or 6 thoughts that are on my mind right now. And hopefully those thoughts will generate enough discussion and enough learning. And I think that, so we can make this pretty freewheeling. And I guess I should start with to say just a little bit about India. I'll let you all into a family secret, not so much a secret, but my wife is Mexican and she can go toe to toe or tongue to tongue with Mohnish Pabrai on hot food. I don't do hot food myself, but the secret in our family is that my wife prefers Indian food to Mexican food. Mexican food also has hot cuisine, but she likes Indian food more simply because Indian food is far more varied. There's a huge amount of variation, whereas Mexican food has very relatively limited number of ingredients. And there are good reasons for that I can explain to you. And I should also tell you that every time I'm in India, I feel like there's some part of me that is from there. It may be because I grew up some of my life in Iran. And so there's quite a lot of similarity, especially between northern India and Iran. And although I apologize to all of you that I have not been to Calcutta, I have been to Bagdogra Airport, where we suffered a power outage. We were on our way to Glenburn in the foothills of the Himalaya. So there are my my very short thoughts, just introduction. To go to thinking about investing, I think that, my story is that I don't think I would have become an investor if I'd not discovered Warren Buffett. I was disgusted with much of what I saw taking place when I was working as an investment banker. And Warren Buffett showed me a new way. But there's also this phenomenon that the people who teach us, our greatest teachers, can also be our biggest limiters. So it's easy enough to say, as Mohnish Pabrai does, that we should clone the best, but the art of cloning the best is a subtle and difficult one, because we can joke about drinking Coca-Colas like Warren Buffett, but nobody here doubts that simply eating peanut brittle and maybe even living in Omaha and drinking Diet Cokes is going to make us into better investors. So finding what to clone and what not to clone is what is really the challenge. And I find it interesting that Warren Buffett's greatest investment in terms of pure dollars in or dollars made from the investment is actually Apple, which is a tech stock. So why do I say that? Because I think that in the United States, there's this idea that when people say this time it's different, actually this time it's not different. This time is exactly the same. And so, but I think that there are aspects of the period that we're going through which really are different. What's different? We're going through an extraordinary, huge, mind-blowing tech revolution that's happening in front of our eyes. And it really, for me, started with the iPhone. I was slow to understand what the meaning of the iPhone or smartphones was, partly because at that specific time I had moved from New York to Zurich. But the advent of handheld devices, but also what has happened in the cloud in, India is a part of that, in that it started off with people realizing that they could have call centers in India, and suddenly you could be in Bangalore and you could go into an office and be talking to housewives in Scotland, and suddenly the world has been connected, all of those things. Why do I say that? So that's the revolution that we're going through, and that presents somebody like me with an extraordinary challenge that I have not yet been up to, and that is to understand that these new businesses are ripping their way through the planet, are ripping their way through many traditional industries. So I don't think, I was interviewed recently on CNBC, where actually she's an Indian journalist, Tanvir Gill, was asking me about value versus growth. I think that such concepts are outmoded and don't really reflect reality. There are large numbers of old economy companies that appear to be cheap on normal measures that I had learned. I'd spent 20 years teaching myself how to understand analyses of cash flow, analyses of price to earnings or price to book. They appear cheap on all of those measures, but actually they're value traps, because the most interesting companies are not showing any income. The reason why they're not showing any income is that they have some very extraordinary investment opportunities, and therefore they take every penny that they make, and some of them are very profitable, but then they reinvest it in the business. So traditional approaches to cash flow and income statement analysis are just not going to work in those areas. And if you happen to be somebody who's been caught up with buying things that are statistically cheap, price to earnings, price to cash flow, all of those things, you may actually find yourself defining your investment universe away from the places that are the most interesting places to look. I was recently in Dubai for an investment conference run, by the way, by somebody who's originally Indian, who's living in Dubai. And my wife and I spent a couple of days in the desert, and it was very beautiful, more beautiful than I've expected it to be. And we were obviously staying in, I don't know if it was a natural, it was certainly a man-made oasis, and there were lots of trees and small deer around. And but if you look into the desert, you see vast areas of sand without much growing there. And to somebody who is a dyed-in-the-wool value investor, walking around that desert and not seeing much of an oasis, they would assume that the whole desert is that way. But if you manage to find yourself in an oasis, then what you really want to do is, first of all, realize that the vast majority of where you live is desert and maybe worth it for small and short forays, but not much else. But you want to stay in the oases. And if you're in one oasis, you don't want to spend too much time in the desert before you end up in another oasis. So I think that the world of investment has become even more unfair in a sense, in that I think that if you go back 20 years, it was quite possible to spend your time in the relative desert and look for companies which maybe weren't at the cutting edge of anything, but still were cheap, and you'd do okay. And I'm not saying that that doesn't exist at all, but I think that whereas perhaps 80% of the opportunity, whereas before maybe it was 60-40, where if you chose to look in the desert, you had 40% of the opportunity. Now it's perhaps 80-20 or 90-10, meaning that this relatively small number of people, mainly based in Silicon Valley, not just, I mean, many of them are moving to Austin and elsewhere, but it's a relatively small number of people who've understood the power of software to eat the world, and 90 to 95% of the enormous opportunities that exist on the planet exist in and around those people. And if you're not there, then you're in a desert, which is, if you're lucky, so I'll just describe it. I mean, that's not, that doesn't describe 100% of reality. There are certainly opportunities outside of there, but they are far harder to find. And you may well find that you invest in, for example, oil and gas, and then you discover that your profits have been normalized because people who are concerned about carbon emissions have decided that they're going to find an extra way to tax you. Or you may find yourself in an industry which has been historically profitable or reasonably profitable, but the competition from the world of tech and the cloud is coming at you in ways that you can't even start to imagine. So I think that presents and that has presented for me an environment that's been difficult for me to adjust to. It's required me, and I'm in the midst of doing it, to go and grab and become interested in a whole bunch of areas that I never thought I would be interested in or would have to be interested in. And all of the knowledge that I gained over the last 20 years, much of it is not all that useful. And so I think that that's a particularly positive message for a younger generation of investors, because you don't have to go and learn all the things that I went and learned, because I'm actually working hard to forget them. And I think that to some degree, the returns of some value investors, the ones who've done really well, are those who've figured this out sooner than others. And the rate at which people figure it out is dependent on many, many things. And in my case, it took me longer to figure out because I was so slavishly and adoringly dedicated to a vision of what value investing and what smart investing was about. And it really started changing actually around Warren Buffett's Apple investment, because that caused me to go back and think about why, when 5 or 6 years ago, I had understood the case for Apple, I had not invested in Apple. So I think that's really, really important. Having said that, we live in, and so it is true that the opportunity lies in those areas that I've just described, which can be put underneath cloud computing, technology, software is eating the world, all of those things. At the same time, I have no doubt that, because I'm not expressing anything new to you probably, or not expressing anything new to many of the people in this room. It is, however, new to me. And it may be interesting for you to know that it's something that I've just come around to recently. But for those people already knew and understood that, let's be clear. I'm very sure that there are many companies in that space that represent enormous bubbles. And they're not bubbles like tulipomania in that, in tulipomania, these tulips were really worth nothing. They had a value as flowers and that was it. But obviously, in this case, a company like Snowflake, which is a cloud services company, is revolutionary, and they're doing something that's extraordinary. It's just that it also may well be a bubble if it's trading at 100 times earnings, and may be a dangerous place for someone like me to go. So, so the second point that I have written down here, I guess actually before I go to that point, I'll give you another point. So how do I mitigate risk in my investments? And you should know that my 3 or 4 largest positions each comprise 20% of the portfolio. So I have about 20 stocks in my portfolio, but the overwhelming weight of the portfolio is in a very, very small number of companies. And I think that the simple question that has become so much more important today than in the past is to ask the question, is the company doing well for all of its stakeholders? So it's not that hard to think about highly profitable companies where there is some stakeholder or other that's getting the short end of the stick. And so the obvious example would be tobacco companies, where these companies are extraordinarily profitable, but it just happens to kill or significantly shorten the lifespan of a certain proportion of customers. Or if you think about a gambling company, a friend of mine has an investment in a company that is the leading, and it's a monopolist effectively in France. It's a lottery company. And it's a highly profitable company, but it's also taking some of the least educated people in France and making them poorer, and at their expense is making some shareholders in the state richer. So you can identify groups that are significantly worse off because of the existence of that company. And I would tell you that whenever you can identify a group like that, then the company is at, I don't want to say serious risk, but it can be just a matter of time, and it might happen within 1 year, 5 years, or the company might continue for a very long time without, in one way or another, there being a backlash and its profits in one way or another getting normalized. And if the company is lucky, the profits get normalized, or what it earns get normalized in a way that doesn't destroy the business. But then also every now and then you might find that the company gets normalized in a way that completely destroys the business. So if we look at some of the tutoring companies in China, it would appear that they have been normalized in a way that kind of completely destroys the business. And so I think that what I seek to do when I'm trying to find good investment opportunities is I've actually started asking myself increasingly, the most important question for me is, does this company, does the company have a mission? Does the company have a noble mission that is consistent with us becoming better off in society? And in general, if the company does not have some kind of noble mission, I am reluctant to get involved. And that is primarily, I've realized that it's a great philosophy to have, but it's also a huge, I think I've dodged a few bullets in my portfolio by doing that. And it's worth saying that once somebody's invested in a company that does not have a noble mission, if it's highly, highly profitable, it's very, very hard for those people to see clearly now. So I had a debate with a friend the other day about Facebook, and he's been invested in Facebook and has made an enormous amount of money. And I suggested to him that perhaps Facebook is the new tobacco. And it's the new tobacco because, yes, Facebook is so absolutely wonderful at connecting people. But, you know, there happen to be teenage girls who will develop eating disorders. And then there happen to be the people who are the victims of pedophilia and other criminal gangs that can organize across Facebook's properties. It seems to me to be a very analogous situation to tobacco, where many people enjoy smoking cigarettes, but then there's just those people that it kills every now and then. So what will happen to Facebook? I think that somebody who's invested in Facebook would want to spend quite a bit of their time investigating that and understanding how that might unfold. But my experience has been that once you're in those things, it's very hard. The friend of mine who has his investment in the Française des Jeux also finds it very hard. So really focusing on those businesses that have a noble mission and who really care about all of their stakeholder groups, and where the entrepreneur at the top is a personality who kind of understands that and wants to take care of all of the stakeholder groups. So one example that is not in my portfolio is a guy in the United States called Reed Hastings, who I actually did sit next to him once, but did not take the opportunity either to get to know him better or invest in his company. But I've seen some of his internal documents on the way they engage with their employees. And so, you know, the employees are just yet another stakeholder group, and you want all the stakeholder groups to be happy with the company, to want the company to exist. And I suppose that this is a kind of another way of saying something that Charlie Munger has said, which is in order to succeed, either as an individual or a business, perhaps what we really need to do more than anything else is to deserve that future success. And if we deserve that future success, then society and people and other organizations will stand aside and will make way and will allow us to succeed, either as individuals or as corporations. But if we don't deserve that success, then we're very likely to run into problems in the future. And so in the past, I would have looked for companies that are the most profitable in one way or another. I would have looked at companies that have the highest returns on capital, highest returns, highest margins, and that would have been an operating indicator of a company that is a good company to invest in. Today, I no longer look for the highest returns, because it's very likely that if you earn extremely high returns, somebody is getting ripped off. Somebody in your stakeholder group is not a happy camper, but they just can't do anything about it. Instead, I'm trying to ask myself the question, what companies are profitable so they can conduct their business successfully, but they can continue to conduct their businesses on a growing basis for a very long time, where everybody who interacts with the company is happy that that company exists. And a great example that is from a long time ago. So the former CEO of Coca-Cola was a man called Roberto Goizueta, who was originally Cuban. And he gave a speech where he talked about how what he wanted for the Coca-Cola brand was for everybody that touches that brand to benefit. And so, you know, we can go to the consumer who pays a certain amount of money for a can of Coca-Cola and quenches their thirst in a way that's perhaps more interesting than drinking tap water, and nicer than drinking tap water, and gives them more confidence because you don't know what's in the tap water, but you do know what's in the Coca-Cola. But the man who has a corner shop, he also benefits, or she also benefits, because it is a good product to sell. It's something that has high turnover, is a recognizable brand. It means that people will come to your store because they know they can get Coca-Cola there. So the shop owner benefits, the distributor benefits, because if we go before the distributor, if we go to the bottler, a bottler could either bottle some no-name brand and they will earn a certain return on their assets. But if they get a very highly recognized brand like Coca-Cola, they will earn a much higher return on their assets. And similarly, government. See, I'm really just repeating points that he made from a talk that he gave. You know, he wanted Coca-Cola to be the best possible partner to every national government that it was a part of. He wanted Coca-Cola to be a good taxpayer. And we see that, for example, in McDonald's, where around the world, there are these Ronald McDonald houses where McDonald's is really trying to be a good part of the community. So looking for companies like that, which aren't necessarily the most profitable, but are the ones that are making society better in some way while still making money. And actually, I'm going to give you two ideas now from a talk that was that I listened to in Dubai by a really brilliant guy called Dennis Hong. And so when you are that kind of company that is capable of creating enormous value for its different stakeholder groups, people voluntarily lock in to your business rather than another business. So this idea that if you are really generating value for everybody in your ecosystem, people will voluntarily lock into you. And so one interesting example of that is that my experience of Amazon is that they're utterly dedicated to giving me something at the lowest possible price. So the people who all lock into Amazon Web Services voluntarily lock in their business to Amazon Web Services because they know that they're locking into a culture, into a corporate culture that is going to keep prices low as they possibly can. The people who buy a membership of Costco voluntarily and happily part with $100 of their money to become a member of Costco because they know that they're going to continue to get really good value inside the stores, and that membership card that allows them to access the store is something that they want to do. By contrast, if we just stay with Costco for a second, on the supplier side, obviously Costco will sit down with the suppliers and say, we need you to develop products and packagings and the like that are going to be extraordinarily good value for our valued members who come into our stores. But Costco works with those suppliers to make
He got disconnected, I think.
I
Yes,
think he'll
yeah.
join again.
Yes, so
Can you all hear me?
Yeah, we can hear you.
I have no idea what happened. I was talking away
yes,
to you
yes.
guys, and then suddenly my Zoom just disappeared, and
Yeah.
you all disappeared. What did you guys see?
You are talking about Costco.
Yeah, and then I just disappeared on you. You wondered whether I still existed. So in any case, here I am. I'm glad that, if that happens again, I'll do the same thing again. I have no idea how or why that happened. So, so I just find it interesting that one of the reasons why Costco is, I think, a really extraordinary business and why Charlie Munger sits on their board is that it's easy to understand why it's a good business from a customer perspective, but from a supplier's perspective, I can't say I've interviewed many suppliers, but as best I understand is that the suppliers are extraordinarily happy to be engaged with Costco because Costco drives them hard, but often they can make up the very low prices with the extraordinary volumes that Costco puts through. So it's still a very, very good relationship for the Costco suppliers. I think that when you're dedicated to doing that, there's something that one might want to look for in one's investments called ecosystem control, in which if you are really that kind of company and people voluntarily lock into you, you are the company that now controls the ecosystem. And we could argue that, for example, Intel was in a position of ecosystem control for extraordinarily long time. Or we could argue that Microsoft or Apple were in a position of ecosystem control. as perhaps the businesses that I've described, Costco and Coca-Cola, also have had extraordinary ecosystem control. So the criteria on which I am trying to find companies to invest in has changed drastically. And my desire to own old economy companies, I know that they come with a very, very healthy danger tag because they could just be value traps. And the equivalent would be walking around in the desert looking for water and saying, I'm never going to go to an oasis to look for water because that's obviously tech and I'm not doing tech, something like that. So, so that's kind of like the bulk of what I think I want to share with you. I think that the only other thing that I will share with you is that I've gone through an extraordinary learning curve on something that is really very, very simple, which is position sizing. I have found it far easier to go through more recent ups and downs and bumps in my portfolio because I've gotten far wiser on sizing positions. So, and I'm not saying that there's a science to it, but in my case, based on my almost 25 years experience of doing this now, and I have come to know myself that to start a position with somewhat under 5% of the portfolio, and perhaps to grow it to 5% of the portfolio, and then to let it ride as long as I can, and not to get too concerned about where the prices go. If they go down immediately, which often happens, or if they go up significantly. So my 20% positions are positions that started off as 5% positions or even 4% positions. And that idea of getting position sizing right, but then leaving the portfolio alone, has been of extraordinary value to me. So I think that I'm going to stop there. I see that there are 2 hands up, and I'm really happy to take questions. I can give you some thoughts, if you like, about how I've approached India, which won't be very satisfying for all of you because I'm an outsider to India, but I'll stop and see if somebody asks me the question. BL, thank you for inviting me. There are my opening comments. Back to you, and happy to take questions.
Thank you, Guy. You talked about technology companies, and these days we find valuations are sky high. So how do you reconcile with those things?
So
any stock in your portfolio?
Yeah, so the first thing that I would tell you is that we need to think about what valuations we're talking about. And so in the past, I looked at valuations in terms of what the business is producing in terms of cash, and forget about book value, but what are the cash earnings of the business? The issue that we have, and the reason why that is no longer a good measure, is that the accounting is predicated on a very clear distinction between maintenance CapEx and growth CapEx. And in general, you are, the way I understand accounting rules is that maintenance CapEx is fine to pay with pre-tax dollars, but growth CapEx is not. If you're buying a new business, there are all sorts of things that you really ought to do with post-tax dollars. But that distinction has been completely ripped to shreds by tech companies, because there's absolutely no way that an accountant or a tax accountant, least of all, is going to start being able to make a clear argument about whether this was growth CapEx or whether this was maintenance CapEx. And so when entrepreneurs discover that they have a very, very good business model that could potentially move around the whole planet. And so, for example, if you look at companies like DoorDash that do food delivery, once you've mastered that strategy, there's no reason why you can't go around the planet. Or if you're Amazon and you've mastered this idea of delivering low-cost distribution via your website in the United States, why can't you go around the planet? You're going to take every penny that you make and you're going to invest it in that future business. And so a guy like me, the guy Spier of 2 or 3 years ago, would have just said, yeah, but they're not making any money. In fact, I did say, I believe that Amazon might be the only business in the history of business that goes through its whole life cycle never having declared a profit. But it turns out that I didn't really understand the nature of this reinvestment in something that is extraordinarily profitable. So, so the first thing is forget about balance sheet assets. That's not going to a good guide to valuation. Then we go to income statement and cash flow statements. And again, that is not going to provide a good guide to value in these businesses. And so we're left with far more subtle and measures and things that require research, like lifetime value of the customer and how much money does it take to, well, effectively breaking that down, what does it cost the company to acquire the customer? And then what is going to be the profitability of that customer over time, knowing that when the business is growing rapidly, it may not be showing any earnings or profit. And so that is new and difficult for me. And often when we see high valuations, it's because the person who's doing the valuation has not broken the company down in that way. Having said that, I do think that one measure that I think cannot be manipulated is, and it's not like the companies are deliberately manipulating earnings and cash flow for the sake of manipulating them. They're doing what any intelligent entrepreneur would do. But the revenue is a pretty rock solid number. I mean, that's not going to change based on whether they're reinvesting in their business or not. And I still think that a company that trades at 100 times revenues, which is, for example, where Snowflake trades, it's very, very hard for me to believe that there's going to be an extraordinary amount of money made by investors buying into it at 100 times revenues. Because even if you assume that all the revenues are profits, that they don't have any expenses to generate those revenues, which of course is not true, but let's just assume that, you're still trading at, quote, well, 100 times, quote, earnings. You've just converted earnings into revenues. And how long can that continue for? So, you know, I have questions about such extraordinarily high valuations, but to take the analogy back to the question, to the oasis, you know, perhaps another way of describing it is, you know, there's so many people looking for water in the oases, and any water in the oases is going to be so many people crowding around it that I'm just going to sit in the middle of the sands and look for water there. I know that that's not a fair analogy, but I think that the answer is, yeah, go to the oases and see if you can find overlooked bodies of water, rather than just to say, well, the oases are overcrowded, so I'm going to be in the desert, if that makes sense. So, and value, I have no doubt valuation still matters. And, you know, I was on a call with a guy called Muji, which is his kind of pseudonym. Muji Hypergrowth is his website. And he just said, oh, I don't look at valuation. And I think that that's probably wrong. And that's an example of bubble-like thinking and bubble-like behavior. But bubbles happen because a good idea is taken too far. And I guess what I'm emphasizing here is that it's a good idea to be looking at these tech companies, and it's a good idea probably to invest in these tech companies. It's just a question of finding the right ones and the ones that haven't gone too far. So I hope that helps. But you know, BL, and I need to apologize to everybody here, because I have, you know, so if you go to Harvard Business School, you know, we just need to remember that 2/3 of HBS is just BS. And, you know, before Harvard Business School, I spent 4 years at Oxford. And there's a guy who's running the country, running the United Kingdom, who went to Oxford. And, you know, so I've had 6 years worth of talking absolute BS and making it sound intelligent. So what's my point to you? I can spend a lot of time saying nothing. And I actually think in answer to your question, I said nothing. Or maybe I just confirmed that to ask the question is to answer it. Yes, valuations are high, and that makes life difficult, you know.
Thank you, Guy. Yeah, Sokji, you can come.
Hi, good afternoon to you. I have two questions. One relating to the understanding of tech. Now, at my age, and I'll find it very difficult to deep dive into the complex world of technology and try to find winners. So, will it be a better strategy to look at a good fund manager whose forte is tech stocks and invest through them?
It's a great question. And I can't, Ashok, and thank you for asking me the question. I can't judge based on the short amount of time that you and I have spent together where your best future lies. And I think that it also is very, very dependent on the exact nature of your network and the people that you know. There could be a guy who specializes in tech who's just the thing, and the guy who specializes in tech could be awful, and you might know some people, or you might have some insights in the tech world that may be better off for you. Just to go to tech for a second, though, I think that, and you know, I feel like you and I, and probably many people here in the same boat, in that it's not an area of expertise for me, but a plan of attack that I have is to, if somebody's trying to bamboozle me with tech, then they're probably not the person that I want to invest with. And the argument would be that there are some entrepreneurs, and probably not all of them, not even a majority, it might be 10%, who are willing and able to sit down, maybe not one-on-one, but on a conference call or an investor call, and talk through why they're doing what they're doing. And so I don't think that anybody on this call does not have the ability to take in carefully what somebody like that says. And actually, Ashok, I think that I would use that criterion both for potentially investing in tech businesses and for potentially investing in a tech fund manager. And so, you know, I think that I could sit down and explain to you or somebody what I'm doing in my fund, and you wouldn't necessarily have to understand exactly what it is, and you wouldn't necessarily understand all the details of what I'm doing, but you'd understand the principles that I'm applying, and you'd understand the ways in which I'm managing myself in my environment to either get confident or not with it. And it came out of the answer to a question that I posed to this guy, Dennis Hong, who's a Korean guy living in the United States. And I kind of asked him about A-shares. You know, A-shares are where the investor gets some very reduced or no voting rights, and the entrepreneur keeps all of the voting rights. And what he said was, you know, he's less concerned about whether the entrepreneur gives the outside investors actual voting rights than he is concerned about whether the entrepreneur can articulate a clear vision and understanding of where he's going, and where his intent is to treat the outside shareholders fairly and to want to make sure that they make money with him. And in many cases, members of his close family and friends own the A shares. So I think where I'd go is, in your case, is I'd make a short list of the tech companies that I like, and I'd make a short list of the tech fund managers that I like. But then I wouldn't necessarily a priority judge between the two. I'd try and identify people who are communicating with me in the right way. And I think you're absolutely right, Ashok, that in terms of, forgive my colorful language, bullshit factor, I'm pretty sure that you have a good bullshit detector. And you know, the minute that happens, that's when you say, no, I'm not investing in that. And the good people will explain. I'll just give one example of that is, so there are South African guys, you know, and I missed them for the first 10 years. They are the people who run the South African company called Naspers. And now they have moved some of that value, some of the ownership of they own a very large company called Tencent, and they have a number of venture capital investments. And some of it is in Naspers and some of it is in a Dutch company called Prosus. But they actually talk through their investments in a very clear and open way that would make sense to somebody like you or me, Ashok. And so in my case, for example, that company has become a position in my portfolio because I am very confident of the ways in which they're investing and their capacity to explain it to me. I don't know if I've been helpful.
No, thank you very much. That has been helpful, and probably I do like the country where you stay, and I keep visiting there. So in one of my next visits, I'll try and check if we can meet and personally talk.
I'd be very, very happy to see
I
you
still
here.
miss Sprungly chocolates quite a lot.
Sprungly are the best, I would tell
Okay,
you.
the second one is a relatively larger question.
Yeah.
You told me that you told the forum that we must look at people who keep each and every stakeholder happy or treat them fairly. But then, my dear friend, if I can call you so, the world is a zero-sum game, isn't it? One gainer, somebody gains at the cost of somebody else, because E is equal to MC square. So in that case, how do you really justify or accept that this is a guy who's treating everybody fairly? It's just not possible. It's against the law of nature.
So Ashok, thank you for the question. Before I get to the question, I'd be very happy to see you in Zurich. I just need to warn you that there are many things that are absolutely spectacular about India. I'm sorry, about Zurich. Indian food or any ethnic food is not one of them. So you've got to be prepared to eat sausages, schnitzel, and schnitzel and sauerkraut.
I'm very happy with Mexican food, my dear friend.
Yeah, there's no good Mexican food here either, I can tell you. And London's got good Indian food and good Mexican food. But so I think that perhaps we can get into a debate. My personal experience of the world is that it is non-zero sum. So there are not everything, but there are plenty of places where 1 + 1 = 3 or 1 + 1 = 11. And, and not everywhere, but so let me give you some examples of some businesses which are zero sum, just to be clear. So, well, I know I have friends who would disagree with me, but gambling is zero sum. You're taking money out of the pocket of the gambler and putting it into the hands of the government and the shareholders. You're enriching the government and the shareholders. Now, the people who say, no, it's not zero sum, is they would say, you can't even imagine how much joy and fun the gambler gets out of his flutter or her flutter, and the enjoyment of the game and the expectation and fun of, but I would argue that that is zero sum. And I could get into other examples, but examples that are very, very clear non-zero sum is, for example, so Amazon takes some suppliers and they can massively increase their volume because they are now selling to the planet, whereas before they couldn't access so many people. At the same time, and we all have wives, who tell me who, I mean, I guess, tell me whose wife here has not done shopping late at night on her computer next to you in bed. I mean, I sometimes feel like every night, and that's extraordinary. I mean, she doesn't have to go to a shopping mall. She doesn't have to, all of those things. So I would argue that that is non-zero sum, and there are other examples of non-zero sum. So we want to find those few opportunities that are non-zero sum, I would argue, but we could have that debate. Let it be my only point to you, Ashok, is in addition to ethnic food sucking in Zurich, my point to you is that at least my experience is that there are parts of the world that are non-zero sum, and but you are free to disagree with me.
My favorite hotel in Zurich is Bar au Lac, and they do something vegetarian for me all the time.
That's great. And there's also a place called Hiltel and a place called Tibbetts, which are supposedly very, very good vegetarian food. The only thing that I would tell you is that it's extraordinarily bland, And
that's okay.
And if
Tabasco is a good invention for us.
Tabasco. My commitment to some of my Indian friends is that next time I'm in Delhi, I'm going to try some street pan. And if BL, if you remind me, I'll send you. He can send you all a link to a video that I took of my wife
Yeah, please send.
betel leaves and the whole shebang in the street in Delhi. But
And even street food.
Thank you very much. Thank
yeah,
you
my
very
pleasure,
much indeed.
Ashok. Yeah.
Yeah, Kishore bhai.
Thanks, Guy, for an excellent talk. My question is related to the first question of Ashok. See, we are all traditional investors, and we do not understand this new age businesses well. So, and we can't invest directly in stocks in Silicon, where these companies are operating from Silicon Valley or from America. Can you recommend to us some funds which are invested in new age businesses and where you feel that there is still good scope for appreciation?
First of all, I think that some of those amazing businesses exist in India, and so it's not a terrible thing to look in India for some of those kinds of businesses. And I'm reluctant to name businesses, but I've been closely associated with the credit rating industry, and so there are some Indian credit rating agencies. The one that I made a huge mistake to sell is CRISIL, but we can do an analysis of CRISIL. So yes, tech is a really important place to look, but there are businesses that have this aspect of ecosystem control and benefit all their stakeholders, which are not in tech, and some of them are in India. And so just to go through it very briefly, in the case of a company like CRISIL, CRISIL is the gatekeeper to the bond markets for so many companies. If you want to access credit in India and you're a corporate borrower, if you don't go through CRISIL, you will pay a lot more for your credit. So you issue a bond without a rating from CRISIL, and you may pay 200 basis points more in terms of the cost of borrow. You get a credit rating from CRISIL, and your cost of borrowing goes down very significantly, way more than the cost that what it costs you to pay CRISIL for the credit rating. So investors love the credit rating. They benefit from all of the surveillance and the reporting and the insights that the credit rating agency gives. So some of those businesses certainly exist in India. And what I would tell you, Kishore, is that, so I'm curious, this will be fun. So you guys live in, most of you are in Calcutta. Does it ever snow in Calcutta?
Yeah.
Come back again, please.
It doesn't snow in Calcutta, does it ever?
No, it
It's
doesn't.
too warm. Yeah. But look, India's a diverse country, but I grew up basically with one word for snow, which was snow. And probably most of you did as well. Did you know that the Eskimos have 30 different words for snow? There's, one word for wet snow that falls in clumps. There is another word for dry snow that blows when the wind is very, very cold. There's a word for compacted snow, 1,000 different kinds of snow. Snow that melted and then refroze, and it's got like big granules in it. So many different words for snow. So what I tell you, Kishore, is that the more you study, the more I study areas that I don't know anything about. I go from somebody who thinks it's all tech, to being a highly variegated group of companies. So, and I'll give you one example of effectively a tech company that none of us would have thought as a tech company is Domino's Pizza. And it's not a company that I've invested in, but Domino's Pizza is an extremely well-known brand of pizza. And a bit like Coca-Cola, what they did is that they put together the technology to make it extraordinarily easy for pizza parlors around the world to meet orders and to deal with delivery companies. And they're actually in a certain way a tech company. And so that's an example of tech becoming highly differentiated and us starting to use language that helps us to understand the differences between the different kinds of tech and where we want to be invested and where we don't want to be invested. So you don't just have to go to Silicon Valley. I think that much of it exists in India, but I think my point to you, Kishore, and to everybody here is we all probably know people in the tech industry. That doesn't mean that we need to sort of start taking their advice tomorrow on where to invest. But I think I'm far more interested in having conversations with them to understand what they're up to. In terms of fund managers, I would tell you that there are managers, value investors, I call them value investors, who are who spend all of their time looking at different models that emanate from the tech space. And so they are looking for example, if any of you have heard of a company called Shopify, I still don't understand Shopify, but it's considered by people in that world to be a potential Amazon beater. Nobody can beat Amazon at its game, but Shopify might be able to, or perhaps already is beating them. And so if you email me afterwards, I'll be happy to provide you with a list of people. They're not people investing in India. They're not people in the Indian realm, but they probably have or look at Indian companies all the time in the same way that they also look at Chinese companies all the time. So I'm happy to send you that list. And just to reiterate, or perhaps I didn't say it yet, what I'm doing, Kishore, and it's going to be really interesting to see where it leads, is that I've now got a list of, so I've got a list of the top venture capital firms in the world, and I've got a list of their investee companies. And you know, like in the same way that, forgive me if I keep going to the desert analogy, you know, at the oases, you've got all the animals, you've got all the water, you've got all the plants, you've got all the everything. And in the desert, you've got one or two spiders, and I don't know what the hell you have on this desert sands. And so, you know, those VC firms, and it's not just Silicon Valley anymore, and their investee companies, they attract all sorts of other resources around them, like very, very high quality engineers, very high quality marketing people, just brilliant people who understand and think about the world carefully and understand a lot about the world. So I'm just going to, you know, Warren Buffett said, start at the A's. Well, I'm developing a very special list, which is these companies, these VC firms and their tech investments. And I'm pretty much going to start at the A's and start getting to know every single one of those businesses to understand the thinking behind them, because that will lead me from the place that I am now of knowing just one kind of snow and understanding all the different variations of snow. I hope that's been helpful, Kishore.
Kishore, just one second. Kishore, give me 1 minute. Mr. Spier, I spent 45 years in the field of finance.
Yeah.
And I superannuated as CFO of the most expensive cement company in the world.
Yeah.
But let me caution you, your understanding of rating from CRISIL, making people get funds cheaper, is probably misplaced in context of India. We'll discuss this more when we meet. I hope we meet soon. Thank you.
No
Kishore,
problem.
please go ahead. I'm sorry.
Who was that? Was that, oh, Ashok?
This is Ashok.
Yeah. If I may respond briefly, I have, you know, there are many people who get very upset at the credit rating agencies because they are not very good at actually getting it right, and they have a lock on the market. So I totally understand that it's not a clear-cut picture, for sure. But sorry,
no, I just made an observation. This was nothing to do with your general hypothesis. Kishore, okay, please go ahead.
And I look forward to learning from you, Ashok.
Oh no way! I will come as a naive to you.
No, thanks for the two examples of the Indian stocks. You know, that has clarified the way you look at them. But let me ask you a related question again. Number of funds, mutual funds in India are launching schemes which invest in US, in Greater China. One has recently launched a scheme for investing in Taiwanese companies. And one fund has launched a scheme for investing in top 10 tech companies in NASDAQ, you know, which would probably cover Google, Alphabet, or Amazon, or Apple, etc. So would you feel that such an investment currently, even though the stock market valuations are so elevated, would give good appreciation?
Yeah, you know, Kishore, that's not something that I would want to do. And I'll just give you a little vignette of my life of the last 2 or 3 days. to give you a sense of why not. I've been operating in Switzerland now for 10 years, and I've had a FINMA license for 5 years. And but I'm not allowed to really get in touch with retail investors because that would require a whole different level of regulation and a setup that I don't have. But a well-known Swiss bank got in touch with me, and they have a scheme, as you put it, to allow me to run a portfolio in which they issue certificates against that portfolio. And all I have to tell them is how I want to allocate the portfolio, and I can update and rebalance the portfolio. And then it would be very, very easy for retail investors to buy into, quote, Guy Spier's strategy. And I'd be surprised if I do it. And the reason why is that the distance between me and the ultimate client right now, the vehicle that I run, I feel like the clients of the fund are almost like my family. They're not quite, but they're almost like my family. And I think that there would be an enormous amount of leeway for either me or the bank to rip off the client. So, for example, this product allows me to very easily hide the fees that I would charge. I could easily charge a 1% fee against the ultimate client over and above the fee that the bank charges. So I think that my issue with what you've described is that I think that the way to invest in equities is either to invest in them oneself or to buy an index, which is just, and then I would only go to a very, very reputable index company like Vanguard, or to invest in a fund manager who treats his investors as if they're family and has the right orientation. And what you've described to me is none of those things. When it comes to deciding whether we're at a peak in the market or not, what I can tell you, Kishore, is that much of my portfolio is not in tech. So I have some tech, but I have, for example, I have a company that owns shopping malls, which has performed horribly, but there it is. And I like the fact that this company owns a large amount of real estate, but I'm fully invested, and I can't tell you where the market goes. What I can say is that those people who were chicken little, the sky is falling on my head, I don't know when this thing's going to come to an end, I'd better preserve lots of cash and maybe not be invested. They would have not invested because Donald Trump was becoming president. They wouldn't invest now because there are tensions with China. There's always some reason. And my decision is to have a full commitment to equities, knowing that it will be a bouncy ride. So.
Okay, thank you very much.
Yeah, my pleasure.
Yeah, Saurabh.
Saurabh, I think you're on mute. Go ahead, Saurabh.
Hello. Yeah. Am I audible?
Yeah,
You are.
Yeah. Okay. Thanks, Guy, for your time. I attended your session 2 years back in London Business School, and had learned about your investment in IEX at that time. So coming to the moat and the tech business you talked about, I was thinking that in addition to existing businesses, lot of wealth gets created by companies like Amazon, Google in future adjacencies or future businesses. So I was curious to learn your mental model on how you evaluate competitive strengths of a company or its culture to innovate and become leaders in future unknown businesses, and how will you evaluate or value that? Thanks.
Yeah, I mean, and forgive me for, it's just an easy but honest thing for me to say is that the best questions are in a sense impossible to answer because they are the very thing we're trying to solve for. And if they were solvable easily, then they would have been solved. And because they're not easily solved for is the reason why we do seminars, and we spend all this time learning and talking to people, all those things. So I haven't solved that problem, and I know you don't expect me to solve that problem. But so how do I go about trying to solve the problem? I think that it's actually not hard to figure out businesses whose moat is widening, whose business is getting better over time. And there are not very many of them. And when we find those kinds of businesses, we want to spend a lot of time looking at them and being very careful about where we're going with them and whether we want to invest or not. And we want to be really thoughtful about investing in businesses whose moat's not expanding. So one example for me of a business whose moat is not expanding is the US banking business. The US banking business is extraordinary. Many of the banks that I've looked at and have invested in are extraordinarily dominant. They have massive barriers to entry. But I don't think that we can say that their moat is expanding. I think it's more likely that their moat is narrowing. And in that case, I think that the good news is that we know that the moat is narrowing, but the moat is narrowing, I think, at a far slower pace than some of the fintech guys and the decentralized finance guys think it's narrowing. And if you have smart managers and good capital allocators at the top, as the moat narrows, if you do good capital allocation, you can still do extraordinarily well. But so my point to you is that reality is like an elephant, and you've got blindfolded people holding onto the elephant, and one person feels the soft snout of the elephant, another person feels its tusks, another person feels the tail. We're all seeing a very, very limited slice of reality. And I think that what we need to do as investors is, first of all, acknowledge that huge drawback that we have as humans. We can only take things in through our eyes and ears, and we have only one brain, and we have only a certain amount of time per day. But to try and treat, what I'm actually describing to you is Bayesian probability. So the thing that we need to do is to say, based on the probability of this being true or not. So I get one fact, or I get a few facts, and then I have to decide what proportion of reality do those facts represent, because I'm not getting a complete sample of all the information that this company or this situation is generating, and then come to my decision as to how I should adjust my probability of whether this is, how I should adjust the probability of whether, let's say in our case, it is a good business or the moat is widening or not. In other words, and maybe another way to say it is, we're operating with an enormous amount of noise, and the only thing that we can do is to try and be intelligent about the decision making. So, for example, if I'm confident that my model of a world in which the smartest people gravitate to the best business models and the best businesses, if I experience somebody who's very smart, who's very attracted to a certain company or a certain business, that should raise my expectation or my probabilistic assessment that that is a good business. So I'm trying to do that as best I can, and all I can say is that it's a very, very difficult task. But it's not going to happen. So it's not going to happen by dint of sheer intelligence. It's not going to happen because I'm more able to rip my way through a company income statement and balance sheet than anybody else in this room is. I think that it's going to happen. And I hope you don't mind, I'm going to give you another analogy, which is, so the movie industry is, for me, I have no intention of ever investing in movies in my life, but if you're associated with enough successful movies, you'll be made a member of the Academy in the United States. And once you're a member of the Academy, more opportunities flow to you, because the expectation for the movie studios is that a member of the Academy, their movies are more likely to be a financial success than people who are not members of the Academy. And so what does that mean? I think that if you told me, Sarah, Guy, go get a successful career in the movie industry, I try to get myself to the very center of that network, because the closer I get to the center of that network, the more likely it is that the opportunities to produce and create movies they're more likely to be successful than not, the closer to the center I get of that network. And so I'm actually trying to do the same thing with my investing. So to give just one minor example, in 2 or 3 weeks' time, so there's a pretty well-known investor in Europe called John Elkann. I am very envious of him. He's 10 years younger than me, and he's the chairman of Ferrari, and I will never be the chairman of Ferrari. And he's a thoughtful guy, and he's a smart guy, and he's holding an analyst meeting in Turin. And so I'm going to go down to the analyst meeting. Why am I going down to the analyst meeting? You know, but it's not just that it's truffle season in India. And if any of you guys are interested, I care more about truffles than I do about hot food. But it's because there's going to be a better quality of person there, and I'm going to have, you know, random conversations with all sorts of people who are also there. It's kind of like this, the analogous idea of moving to the center of the academy, if you like. So constantly study good businesses, study the actions of smart people, both fund managers and managers, and constantly acquire that and acquire and move my way through the network of investors and companies such that I'm in my own version of the Academy Awards, if you like. And I didn't really talk to culture, but I would argue that it's the same thing with culture. And just to, sorry, Saurabh, just to finish off, it's a story that I've told a few times now. So at the TED conference that I was attending, I sat next to Reed Hastings. And so what I said to Reed Hastings is I turned to him and I said, you know, I have a big problem with Netflix because, you know, all these movies that I want to watch, I can't watch them in Europe because your licensing's up the creek. And, you know, I could have done so many things sitting next to Reed Hastings. And I think being a dissatisfied customer was not the best card to play, but that's the idiotic card that I played. I was an idiot. But Reed Hastings treated me so well. He looked at me and he answered me in a nice way. He said, yeah, we're working on it. And he obviously didn't extend his time with me. But if I think back to that, I think that was, you know, we talk about, I don't know Reed Hastings' personality, but that was a significant data point that I did not pay attention to. And that should have caused me to reevaluate who Reed Hastings is and what kind of guy he is. And I think that if I would have used that information properly, I think it would have increased the probability that I would have invested in Netflix 10 years ago, and I would have made an absolute killing there. So, and again, that doesn't mean I know Netflix's culture, but it should have caused me to significantly reevaluate what I suspected at their time their culture was. How did I do, Saurabh?
Thanks so much. I'll join the queue because others are there. Yeah,
Thank
and
you.
maybe when you are in London, so maybe I would love to attend another session.
Oh, thank you. Yeah, that was quite a busy session, wasn't it? There were a lot of people there.
Yes.
I had a new office manager, Chantal Hackett, at the time, and she couldn't believe how many people had turned out. I mean, it was about 200 people in the room.
Yes.
Well, congratulations on getting to London Business School. It's a spectacular business school.
Yeah, thanks for that.
Yeah, Pranay.
Yes, thank you so much. And thank you, Mr. Spier. It's been very enriching to hear you and read about you. So two quick questions. One is that, you know, as you mentioned, even say Domino's is a tech company. So similarly, any listed stock exchange is also a technology company, considering that now we're all trading on the platform, accessible anywhere in the world. So would you also treat that as a technology company, firstly? And secondly, your view on cryptocurrency?
Yeah, so which company is also, you're talking about the stock exchange itself?
Yeah, almost all the stock exchanges are listed.
Yeah.
So aren't they also technology companies, monopoly businesses with very high moats?
Absolutely. They're certainly technology businesses. And I think that what's really interesting about all of those stock exchange businesses is that, so what my best understanding is that what the regulators are likely to do is that, and have already done in Europe, is that they don't want the stock exchanges to make supernormal profits. So they will find ways to pick away at the monopoly. And the monopoly comes because it's the sole place where you can get liquidity. So if you have to put your shares somewhere, you're going to put them where you're going to get the most liquidity. But the regulators can counter that by forcing the stock exchanges to open up their order books so that everybody else has access to the most updated prices and the most updated volumes. But it turns out that And it's exactly to your point, all of the interconnect. So, you know, if I'm a company who's wants to buy or sell shares on the London Stock Exchange, there may be the London Stock Exchange may have been regulated in such a way that I can get the liquidity elsewhere. But I have all these wires and software on my desk and settlement systems and a whole bunch of other stuff that I need to have in place in order to actually trade shares on the London Stock Exchange. And that is, to your absolute point, that is technology. And once the technology is in place, I mean, do I doubt that Google can produce exactly what Amazon, the same kind of computing ability as Amazon Web Services can provide? Absolutely. But once Amazon Web Services is in a company, once you've got all the engineers to hook up your IT systems to Amazon Web Services, how likely are you to hook your IT systems up to another one? It's less likely. So absolutely, Pranay, you're absolutely right. And even if they take away some aspects of the monopoly, my conclusion is that they are extraordinarily dominant businesses and provide, it's hard for the average member of the general public to understand, but you know, there's a reason why the New York Stock Exchange is at the center of an American life. And there's the ability to find out what assets are worth and the ability to get liquidity for those assets is absolutely central to the economic life of any country. So when it comes to cryptocurrencies, here's where I've come out on cryptocurrencies. So, you know, I would love to call it tulipomania, and it's a complete bubble and completely worth ignoring. And I would love to be able to put my hand on my heart and follow Charlie Munger and say this is rat poison squared. And I do think that that's wrong. I think that the idea that we can trust a counterparty that we've never met in terms of with regard to payments is a mind-blowing innovation. And I described it on CNBC as revolutionary as HTTP protocol. So, you know, suddenly with HTTP and TCP/IP, which kind of the plumbing of the internet, we just plug in. We don't know where the data is coming from. We don't know what path it takes through the wires to get to wherever it goes. All we know is that we type in a web address and the plumbing takes care of the rest. In the past, when it comes to bank or payments, we would need all the banking infrastructure to allow that to happen. So in a certain sense, we needed to know who our internet service provider was. But with the advent of the blockchain, with the advent of cryptocurrencies, that becomes trustless. You don't need any of that. You just need to know your key, and you need to know who you want to send it to, and no, you don't have to worry about whether it was sent via SWIFT or the HSBC or Citibank or, you know, who's your correspondent bank. All of that goes away. So no question in my mind that it is utterly revolutionary. But there is also no question in my mind that many cryptocurrencies and experiments with blockchain today are not going to succeed. And to be able to, for me to decide what will succeed and what will not succeed, I've put into the too hard category. So if I had clear insights, if I could certainly say that something was going to succeed, without doubt, I would take a very, very close look at it. I think that it's for those reasons that Coinbase in the United States is generating an enormous amount of attention, because people come to the conclusion that no matter what cryptocurrency succeeds, Coinbase will be at the center of it, because they've made a few very simple and very good decisions. They first of all said they're going to fully comply with US regulations and other countries' regulations as well. So they kind of make a commitment to the regulator that says, you know, we're not about Silk Road, trading drugs, anti-money, all of those things. We're completely above board in that regard. And then they're in the classic case of, in the gold rush, you talked about the businesses that weren't trying to get gold. They were selling pickaxes or jeans to the people who were in the gold rush. So they're a classic example of selling the equipment that people need in order to do the gold rush. So there's the argument for Coinbase. There's also a pretty good argument for Bitcoin for having been the first. And so the network of Bitcoin is just so much larger than any other cryptocurrency. And I know that Ethereum has been extraordinarily strong, and I understand in very simple terms the basis on which Ethereum operates and this idea of gas, and it provides computing power, all of those good things. But then I have a friend who's going to a conference called Solana. And what I hear about Solana is that it may well be better than Ethereum. And so in any of these cryptocurrencies, even the ones with the largest market cap, I can't be certain that any one of them doesn't go to zero. Because the minute something comes along that really does replace it better, then it could go to zero. There's nothing stopping it. All of that is a long way of saying that I don't think, I don't think it's worth debating in my mind. I don't think, and just to give you this as kind of where I come from is, imagine I'm a farmer and I'm on a wheat farm. It's a beautiful wheat farm, and we produce high quality wheat, and wheat goes into bread and cereals, and people eat this wheat from all over the place. Now, some of my competitor farmers who don't have as nice farms as I do are leaving their farms and going to the city to invent steam engines. There are new textile machines, and I'm kind of describing a situation that might have happened during the Industrial Revolution in England. There were so many new machines that were being built, so many versions of the steam engine. I don't think that if you are a farmer in the position that I described, you drop everything because people are inventing the steam engine. By contrast, I just look and say, that's great. All that work inventing steam engines and other newfangled equipment of the Industrial Revolution, these people are going to be hungry, and I'm going to sell them bread. So, all of this all of this crypto activity is still going to result in demand for all the things that the companies that I'm invested in provide. But my point to you, and my point to anybody who wants to listen, is that I don't think it's rat poison squared. I think it is revolutionary, but I still don't think that it's investable for my fund. And I would also tell you that I take it very seriously. It is my responsibility to look at those things very seriously. And you didn't say this, but anybody who wants to listen, I'll say this. The people who dismiss it out of hand my respect for those people is diminished, because I don't think that that's the right way to approach it. It kind of like is a slightly closed-minded way of looking at those things. And just to go back to Charlie Munger for a second, Charlie, so the question comes to me, well, you revere Charlie Munger and he's called it rat poison squared. And my answer is, I'd also probably, if one of my grandchildren was saying that they wanted to get involved in cryptocurrencies, I'd probably also call it rat poison squared, because even if it's not, I don't want my grandchildren spending all day playing around with cryptocurrency. So how'd I do?
Thank you so much. Still in the limbo whether to invest in it or not, but yeah, thanks so much.
So Pranay, and just for your fun and interest, so I was in a restaurant with a friend of mine in the mountains, and we'd agreed to go Dutch, and then he had to leave in a hurry and was unable to pay his share. And a couple of days later, he texted me some Bitcoin cash, about $100 worth of Bitcoin cash. And so, I would urge you to just have some fun with some Bitcoin cash. Go get $100. And I don't think don't put your life savings into it, but just kind of start to try and understand and to actually own some, I think is not a terrible thing at all. And sorry, Pranay, and before we get to the next questioner.
Yeah, last question.
Yeah, so, but sorry, BL, just one thing there is that it's just interesting for you. So I'm part of a group that discusses cryptocurrencies. And so we did a couple of seminars, and then I said, okay, I need to get into this. I'm going to start looking at things like yield farming, and there's a cryptocurrency called Sushi Swap, and they're decentralized finance where you can stake your own crypto. So I spent 3 days in this, and I was so deep down a rabbit hole, and I just made a choice. You know, it's like I spent 3 days in a steam engine factory, but I'm a farmer. I know about wheat farming. I don't want to spend my days in steam engine factories. So, but yeah, the great thing about being an investor is you don't have to do all or nothing. You can do $100 worth and see what happens, and see how your orientation is. But thank you, Pranay. Back to you, BL.
Yeah, Kanyaji, this is your last. Are you there?
Yeah, I'm there, Chandakji.
So this will be the last question, and
All
after
right.
wind up.
Sure. Thank you so much, Chandakji. Thank you, Guy, for the wonderful presentation. So I'm from Kolkata, based in Dubai, and I worked with UBS for 5-6 years. So
Is it just me, or?
I think he has a network problem. Chandakji, Mr. Narang also, I think, wanted to ask a question. If you can ask him to get
Anil,
in,
can you
fill
ask?
in.
You're on mute, Anil.
Yeah,
Hi,
Anil, can you ask?
good to meet you. Yeah, I've also been to over 20 of Buffett and Munger's meeting. The issue I constantly grapple in this technology age is with their focus on sustainable,
the
long-term,
invitation came for
predictable.
this, and then talks about.
Sorry.
Yeah, he got disconnected. Mr. Narang, you can please go ahead then.
Yeah, Anil, you can continue.
Yes, I would like to find out your view on how does one assess investments, trying to take Buffett and Munger's investment thesis of long-term, sustainable, predictable, competitive moat with the technology changes that's going on, and slightly separately is also if you think interest rates are presently transitory or semi-permanent, and how all this will impact the markets.
Yeah, and two great questions. And so if I go to the first question, and obviously, so Anil and all of you understand this now, I'm going to waffle for 5 minutes and pretend to answer it. But then when you get to the end of the answer, you're going to realize I said absolutely nothing. But maybe I'll do better than that.
No, you have done very well this presentation.
So, you know, so I think that it's important to remember that Warren Buffett was born, I think, just before or just after the Great Depression. His parents and teachers were very, very deeply impacted by the Great Depression. And when he was an adult and when he was studying under Ben Graham and working for Ben Graham had identified that there were many, many companies, so equities were hated, and there were many companies that were trading at below liquidation value. And so so the question that I ask myself, and I don't have an answer for, is that how much of what they succeeded in doing is a result of the genius of Warren and Charlie, and how much of it was that they had the right ideas fitting the right period in history. And so if you would have taken those same ideas of discount to book and tried to apply them in a different era, and if they had tried to apply them, they would not have succeeded at all. And so I think that it brings us back to the very beginning of our talk, that so every time value underperforms other kinds of investing, people say value investing is broken. And then all the dyed-in-the-wool value investors like, you know, Guy Spier come along and they say, no, it's not broken. You guys are just impatient and you constantly think the world has changed, but it hasn't. You know, and just to take the elephant analogy, we don't know. I don't know. You know, I'm holding one part of the elephant, somebody else is holding another part of the elephant. So, but I think that we're going. So the period of technological change we were not going through in the years after the Great Depression. I don't think that the degree of technological change was as great as what we have right now. We're going through something that is way more profound for society, and maybe there'll be a period in which the frameworks of Warren and Charlie and Ben Graham will be more relevant, but I just don't think they are right now. And the answer is, I thought that all I had to do was figure out, you know, Washington Post, one newspaper town, find towns in the United States with one newspaper and invest in them because they can raise their prices ad nauseum. That's just not the world we live in. And yeah, so how do we find them is another way. I think my response to you is that it's hard. And if it was supposed to be, if it was easy, everybody would be doing it. And, you know, certainly the wrong answer is to just keep banging on about low price to book or low price to earnings or any of those things. And I'm certain that part of the answer is to start trying to understand how the world has changed and where it's moving to. And look, there's a venture capital firm called NFX. The guy who runs it is James Currier. And he had this simple insight that networks are valuable, and but not all networks. And he's gone and studied very carefully. So there are some networks that just keep getting more valuable as they grow, but there are some networks that top out. If I understand him correctly, networks like Uber and Lyft, so these ride-sharing services, they actually top out. So there's a kind of a saturation point at which there's no benefit to having extra cars or clients on the network. And so those are not as interesting businesses as networks that don't top out. And he's trying to make those distinctions and invest as a result. I think we need to, you know, Anil, if you know James Currier and you want to set up a meeting between the three of us, I'm joking, but very seriously, I think that you and I would come out of a conversation with him with some great places to look for investments. And just to give you a sense of, on one of the podcasts I've listened to, James Currier was talking about, he was on the board of eBay, I believe, and Jeff Bezos had come to him and he'd said, you know, you should go off the board of eBay because we're going to compete with eBay. Amazon are going to compete with eBay and we're going to blow them out of the water. And why would you, a friend, want to stay on the board of a company that's going to get blown out of the water by Amazon? And, you know, Amazon did not succeed. That was the power of eBay's network. So what James Currier did is that he then went and said, well, that was pretty incredible. I mean, and he sort of says on the podcast, eBay's technology relative to Amazon's pretty clunky, and, you know, the website not very good and all sorts of things, but it didn't matter. The network that they had built could withstand an Amazon style onslaught. And so now he's out looking for other businesses that have those qualities. And so if, you know, Anil, when you get that conversation between the three of us, we'll come away with some really, really good investment ideas. And, you know, we had Pranay and I mean, we had the short conversation about stock exchanges. I think unlike eBay, Pranay, the issue with stock exchanges is that there's always a risk factor as to, you know, I always worry that there'll come a set of regulations that actually destroy the business, and we can't be entirely sure. And because it's so central, it's more likely to happen in stock exchanges than on eBay. But so in terms of interest rates, you know, I happen to have referred to the Great Depression. The central banks, the Central Bank of the United States, the Federal Reserve, did not understand what it was facing as the Great Depression hit. And they took some very, very, very bad decisions, which are completely forgivable. But it made the great crash of 1929 and the economic mayhem that followed far, 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 far worse. until Roosevelt came along and Keynesian economics came along and kind of basically told these people, you're doing this completely wrong. Ben Bernanke during the financial crisis understood the mistakes that had been made by central banks at the time and didn't repeat those mistakes. I think that that has become common knowledge around the world, and there is absolutely zero intent by any central bank to repeat the mistakes of the Great Depression. And so far, we have seen them be extraordinarily accommodative during the global financial crisis and during the initial crisis from COVID. And so I think that leads me to believe that they're going to continue to be extraordinarily accommodating. And if you and I were sitting at any one of the world's great central banks, we'd all want to talk about tapering, because we know that the worst part of the pandemic is coming to an end, and we know that we don't want to make money too freely available to everyone. But we're not going to taper in a way that causes another crisis, and everybody knows and understands that. That's a long way of saying for me that I think that interest rates are going to remain extraordinarily accommodative. There's no intention to change that. And then I will just add, and so then you ask, well, isn't there going to be inflation? And doesn't that mean that we're going to have prices run out of control? And this is my experience and my thinking is that, you know, the news cycle, they always have to have something to talk about. So, you know, how long can you talk about the pandemic? And, you know, there are different stories that you can do around the pandemic. And suddenly the story of inflation gets hold. And because we do have some supply chain issues and prices are rising in those parts of the supply chain, then the story of inflation takes hold. But famous last words, I may be completely wrong. I do not believe that the price rises that we see are anything other than localized price rises in particular industries for particular reasons. It's not across the board. And then one can ask, yeah, but the debt levels have gone through the roof. How are we going to get through these huge debt levels? And, you know, I'm hugely influenced by a couple of academics called Carmen Reinhardt and Kenneth Rogoff, who introduced a concept into my mind called financial repression. And financial repression is where a government forces its financial institutions to buy its debt at the interest rate that it requires. And so Reinhardt and Rogoff looked, for example, at the period post-World War II in the United States is one of the periods they look at, in which, without enormous amounts of inflation, the United States worked through an overhang of debt that had risen through World War II. And so bottom line is, central bankers, with the help of enormous amounts of regulations and cooperative governments, have ways of working off the enormous amounts of debt that have been taken on without going to extreme inflationary environments. Long story short, I'm not worried about interest rates. I'm certainly not letting it stop me from investing or pull away from having a fully invested portfolio. And you know, just let everybody note that Anil is nodding his head. Let me tell you why he's nodding his head. In my belief is that he's nodding his head because he's saying, yeah, he just waffled and said complete BS for 5 minutes. And he's right, he can waffle for a very long time. I've basically said nothing, but you know, don't ever forget that people like me were taught, you know, in my case, 6 years at institutions of higher learning, to waffle and say absolutely nothing and make you guys think I said a lot and actually think that I might be smart about it. I want you to know that every single member of the British government pretty much is an expert at doing that, but realize they know nothing.
No, your entire presentation has been very, very good and fluid and logical. Thank you so much.
Yeah,
and thank you, Jay, for giving us a lot of insights. And can I ask Dhanesh Mistry to propose vote of thanks?
Thank you, Chandakji, and thank you, Guy. Thank you for taking the time out to talk to us. We really did enjoy your candor and your analogies as well. And you know, as you talked about Indian food and the spiciness, I must say that that your presentation to us really left a nice sweet taste with us, and we can now enjoy dessert at dinner time. Thank you so much, Guy, and we look forward again to having you on our group. And thank you, Chandak-ji, once again.
Yeah, and thank you, Guy. Whenever you are in India, let us know. We'll be
Yeah,
delighted
thank you.
to host you in Kolkata or meet you wherever you are there.
Well, equally, I should say that vote of thanks and this whole talk has left a sweet taste in my mouth as well, a very, very sweet taste. And I would be remiss if I were not to say that I think it's a very exciting time to be Indian. I think it's a very exciting time to be in India. Let's not forget, India's, you know, post independence in 1945 or whenever it was, just after World War II, India did not go through the easiest period. And I think that increasingly, I mean, I think the reputation of the country, the reputation of Indians around the world as an ethnicity it's a wonderful time to be Indian. One can be increasingly proud of being Indian. And I feel very lucky and grateful for the association. I would tell you, I tell you all to go to, and I feel warmth in this room, even though most of you have switched off your videos, but that's okay. You should all know that there's a part in my book. I used to go to the Berkshire meetings. I'd hang out with these very serious investment bankers, you know, all dressed in suits. And then I met Mohnish Pabrai, and I got to meet and forgive me, anybody here who's got a closer, I love the United States, but I am not a big fan of the American sense of humor. And so there I am, I'm suddenly now hanging out at the Berkshire Hathaway meeting with all these Indian friends. And we just had the most laughs. My Indian friends had a sense of humor that I got and was wonderful. And so you represent to me in part a change in me that could not have happened without me connecting up to Indians in Omaha. So I'm excited to be a part of the India story, even if in a tiny way. And believe me, the future is bright for India and Indians. So
thank you.
And thank you. Yeah.
Thank you so much.
Thank you.
So see you all again. See you all again at Berkshire or elsewhere. Yeah.
Yeah. Definitely.
Thank you.
Thank you.
Yeah.